All right, so we are going to take a look at a number of case studies, quite a bit here, different individuals of different ages ranging from a newborn, age 0, all the way through age 80. And we are not going to cover all of these in this video. In fact, we're not going to cover any of them in this video. What we are going to do is really set the groundwork for these case studies so you can understand how we're designing the policies, how we're using them, what companies and products are we using, because we're going to look at a variety of different products and such. All high cash value life insurance policies designed for maximum cash value and flexibility. But if you are considering a policy, but you want more information right now and you're saying, hey, what would something look like applied to me? And you're not at a position where you want to reach out to us or anyone right now. You say, hey, I just want to take in information, but I'd like to see some actual examples, not just concept and someone talking about this. So we're going to look at several examples here and reasons why people are using this product, and some of these case studies will be as follows. We've got college planning, long-term savings, we've got grandparents' delight. You'll see what that means as far as setting up a policy for a grandchild, car purchase, real estate purchase, money available for business. That is one of my favorite things. And then the core benefits of a cash value life insurance policy. So each case study, we will look at someone of a different age and gender. But what we're going to touch on here, again, to set the groundwork, is the funding and then plans for the money. So we touched on the plans for the money, but when it comes to actually using a cash value life insurance policy, how does it work? I want to be aware of the mechanics within a policy, specifically when I take loans, the loan interest, all of that good stuff. So when it comes to funding, let's touch on this first. We've got our policy design board here, and you see maximize cash value and flexibility. This is the first thing we will always touch on with policy design. And the reason why is when you hear the word life insurance, what often comes to mind? When you hear the word insurance, premium, bill, I have to pay the same amount for the same period of time. And frankly, it can be a little boring. I have life insurance that's expensive. I don't want that. I'm interested in the cash value component. Now, what's exciting is if I can put money in a high yield bank account and add more at my discretion. If things go very well and I have more money, I can throw it in. If things don't go very well, I'm not obligated or committed to a high premium or high payment to add into that bank account. So in a lot of ways, you can take that approach I just mentioned with a cash value life insurance policy, where again, we can maximize the cash value and then also the flexibility. So when we actually design a policy, if you've ever been presented cash value life insurance, your money can go towards one of two areas at the end of the day. The premium, which I'll often refer to as the insurance expense, and then the PUA rider, that stands for paid up additions, which we will refer to as a cash dump in. So what I want to understand here, if I'm you, I want to understand the relationship of my money that I'm paying into a policy. If you want to maximize cash value, this will show you how. So if you're going to pay in, let's simplify this, $1,000 per year towards the premium and $1,000 per year towards the PUA component, what will show up in cash value and what will not show up in cash value? So the premium we refer to as the initial insurance expense. The reason why is in respect to your cash value, you will see zero of that $1,000, the same thing if it's $10,000, show up in cash value in the first and second year. The reason why is really that the insurance company is overcharging me for the death benefit up front or the cost of insurance. Now, as time passes, if you've ever seen a traditional old school whole life insurance product, you do know or likely notice that eventually your money starts to come back to work for you. Usually it's the third year where that $1,000 premium does show up in cash value and begins to earn dividends and interest. The pace begins to accelerate. I start to see some of my payments show up. But still, nothing shows up in the first and second year and takes a long time to capitalize the policy. Who wants to wait a long time for anything? Typically, we don't. So, PUA payments, dollars that go towards this area, show up in cash value. This is money that you, as the policyholder, have access to. Begin to earn the guaranteed rate and any dividends right off the bat. This is the key to accelerating the cash value on a policy immediately. Now the term PUA stands for paid up additions because these payments will purchase us what is called paid up additional life insurance. They will buy us some death benefit. Now, why everyone positions money in these products and really this area is because it immediately accelerates the cash value growth, money I see right away. So a common question we receive is, how do I put all of my money towards the PUA component, nothing towards the premium, because I don't care about that, Steve. I want to see my money show up, I want it here, and I want maximum cash value long term as well. So what we want to be aware of are really the limitations. Two limits to be aware of. We have the insurance company limits, and then we have the IRS limits. Let's touch on the insurance company limits first. All companies have different limitations. If you look at the larger mutual companies, like a Mass Mutual, a Guardian, a New York Life, or a Northwestern, they all do not have this minimum, but often the lowest we can drive the premium down to is approximately 10%. Now what that means is that is 10% of our total desired payment. This 10/90 split we'll often refer to. So if I have a $1,000 premium, that means I can pay an additional $9,000 per year into PUAs, the ability to make a total payment of $10,000 per year. Now again, all companies have different limitations here. Some let you go a bit higher, some are not as aggressive as that. So it does depend on the company, and we've got plenty of information and other videos on that. Now, that's the insurance company limit. So when we set up a policy, if I want the ability to put in $10,000 per year, like you will see in some of the case studies, we're going to have the premium at $1,000. If I want the ability to put in $100,000, I'm going to set the premium at $10,000. How do I minimize the insurance expense and beef up the cash value? IRS. So what is a huge, huge benefit to cash value life insurance? If I do everything properly, I can use the money tax-free. That can go away. Any life insurance policy can become classified as a modified endowment contract, a MEC. If this happens, the cash value in a life insurance policy does not have the same favorable tax treatment that it normally does. If a policy becomes classified as a MEC, what happens is I have to deal with taxes. In short, your cash value still grows tax deferred. However, if I ever access it, I have to pay ordinary income tax on the gains and a potential 10% penalty tax if I touch it prior to age 59 and a half. Now, with that said, the death benefit is still paid out income tax-free with modified endowment contracts. But the whole purpose of a cash value life insurance policy, if cash accumulation is my goal, safe, liquid, tax-free area to position money, this ruins it. So how do I get rid of this? Well, every policy has what is called a MEC limit. And it is exactly what it sounds like. It is a limit that determines the maximum amount of money we can pay into a policy per year and still have the IRS view our policy as life insurance, not a pure taxable investment. So that limit, what many people are not aware of, is we can set it wherever we want. How we do this is that you will find it has a direct relationship to an individual's age and total death benefit on a life insurance policy. That is, call it the measuring stick that the IRS uses to determine if the policy is life insurance or a taxable investment in their eyes. And we can set that up quite easily. So you may have heard, if you ever considered cash value life insurance policy and you ask the question, hey, can I make this policy more attractive? And then you're told, no, it'll mech if you try and put more money towards the cash value. Well, that may very well be true, but it really is important how we set it up from the get-go to build in a higher mech limit. This way, if we want to add more money to an existing policy, we can do so. And we're going to touch on this kind of stuff with case studies, because the case studies are meant to bring attention to questions that come up quite a bit from people we work with. So this is how we design a policy for maximum cash value, and then also maximum flexibility. Because if I want the, let's say, ability to pay in this $10,000 per year, but I do not want to get a bill for it. Same thing if I add a zero here. If I want the ability to put in $100,000, but I don't want to get a bill for it, you can construct these policies to be very flexible, where the PUA component is not required. I do not have to pay that the same time as the premium. I don't have to pay it at all, depending on the company and their flexibility terms. Point being is I can commit easily to just this. Let's use the $1,000 premium example. I can pay just that, and then at my discretion, I can add more money into the policy to the PUA rider to accelerate the cash value growth. It is worth noting that we'll have to utilize a term insurance rider, but we're not going to go into detail on that because it's a small topic. So here is how we maximize the cash value and flexibility. We make it flexible in the sense that we can commit to just this and then add more funds to the PUA component at our discretion. Now, step 2 is plans for the money. How do I actually use the money? So quick example here. Once a dollar passes through the cash value of a life insurance policy, regardless if I just let that dollar sit and grow, accrue interest over time, or if I elect to borrow against it, no matter what happens, I will continue to earn interest on my full cash value as if I never touched it in the first place. To demonstrate, if you have a policy with a dividend rate of, say, 6%, cash value of $100,000, and you say, you know what? I want to pull some money out to hyperfund my business, or the stock market just crashed. I see an opportunity there. I want to access my money here. We pull out 50% of our cash value. We have $50,000 remaining, and we pull out a loan of $50,000. Now this 5% here is the loan interest that goes to the insurance company. When we take a policy loan, just like if we take a line of credit or mortgage against a piece of real estate, there's interest that goes to the lender. Same thing here with a cash value life insurance policy, in the sense that we borrow, we have a cost to borrow at 5%. However, the company tells you and I that they're still going to pay dividends on the full $100,000 as if I never touched it in the first place. Meaning that 6% dividend is applied to the remaining equity and on the $50,000 outstanding. Just like a piece of real estate that you own, if it's appreciating at 5% every single year, it doesn't matter if we have a loan outstanding or if we own it free and clear. If the appraisal value goes up by 5%, the appraisal value goes up by 5%. Same thing here with the life insurance policy, only difference is that you have contractual guarantees that will go nowhere but up over time. So that $100,000 continues to compound no matter what happens. So if I have plans on utilizing a policy for expenses, business opportunities, using it as a personal line of credit, or perhaps income down the road, this is a big one, I can do just that. It's just seeing it in action, seeing examples for yourself, because there are a lot of creative concepts around cash value life insurance and really all products, but it's really seeing how it applies specifically to you. So the purpose of these case studies is really to provide samples so you can see it. And as always, if you have questions, reach out anytime. I do hope that this one was helpful. We'll talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.